Oil just hit the 96th percentile, and oil at this percentile has preceded demand destruction in 4 of 5 cycles. Something is breaking beneath the surface, and the data confirms it. Right now, oil is at $96.6, the 96th percentile for the past year. Historically, oil at this percentile has preceded demand destruction in 4 of 5 cycles, says the data needs to confirm. The commodity analyst says, we are in a commodity supercycle driven by underinvestment and deglobalization. In the next few minutes, I will show you who the data says is right and what it means for your money this month. The scoreboard just changed. A scoreboard flip means the numbers shifted. Pay attention to what moved and why. The commodity analyst is right and the data keeps proving it. Oil at $96.6. 112-day streak, Gammon called it. Credit will blow out. Yield curve at 0.50% confirms it. 36-day streak, Snyder's dollar liquidity crisis call is paying off. Yield curve at 0.50% and trending their direction. Score 1 for the volatility expert. Volatility expansion. VIX agrees at 19.5. McElroy is waiting on confirmation. The narrative holds, but the data has not validated it yet. 111-day streak. Hartman might be right, but the data has not confirmed the thesis yet. 105-day streak, the dollar analyst just moved from right to early. The dollar analyst might be right, but the data has not confirmed the thesis yet. Score today, 4 right, 3 early, 0 wrong. When a speaker moves on the scoreboard, it means the data changed, not the opinion. That distinction matters. Today's big question, are commodities in a supercycle, or is this the top? On one side, says the data needs to confirm. That is the setup. Everyone hears it on the podcasts, it sounds convincing. On the other side, the commodity analyst says, we are in a commodity supercycle driven by underinvestment and deglobalization. Two smart people, opposite conclusions. So who is right? Here's what the data says. Oil at $96.6, 96th percentile, down 1.3% today. Gold at $4,787, 84th percentile. Copper at $5.89, 91st percentile, up 2.4% today. Bottom line, the data is split. Neither side has a clear edge, which means the resolution is coming soon. If oil drops below $80, the supercycle calls in trouble. Right now, it is at $96.6. If copper breaks to new highs while oil falls, it is demand rotation, not a supercycle. Oil at $96.6 is in the 96th percentile, reversal territory. If it drops below the 75th, the thesis weakens fast. Gold at $4,787, we'll track it daily on the scoreboard. Phase 1 is the good times, but good times do not last forever. Here's how close we are to the edge. We are 67 basis points away from Phase 2, the phase where credit breaks and volatility spikes. There is no acceleration in credit stress yet, but we are watching the pace, not just the level. The trigger, investment grade spread crossing 150 basis points. Currently at 83 basis points. Pace is flat or improving, no urgency right now. Phase 1 means risk on is working. Equities, commodities, and real estate all benefit from loose conditions. Enjoy it while it lasts. For context, the last time credit stress built like this, credit spreads blew out and high-yield bonds saw drawdowns of 15%. The credit and rates layer has copper-gold ratio, equity risk premium flashing red. Gammon says the Fed is breaking things and credit spreads will blow out. The data agrees with that assessment. Phase 1 holds with 67 basis points of buffer. Conditions favor risk, but do not get complacent. Wall Street trades the index. We trade the ground. Here is what the ZIP level data is screaming about today. HI, days on market is collapsing in Capaya. Days on market in Capaya moved 98% in 30 days, now 56 days. 98-100. Days on market is the cleanest, 100. Days on market is the cleanest leading indicator we have. Big swings mean liquidity is changing fast. NH, days on market is spiking in Lebanon. Days on market in Lebanon moved plus 98% in 30 days, now 138 days. Buyer leverage score, 78-100. Days on market is the cleanest leading indicator we have. Big swings mean liquidity is changing fast. Humboldt, CA, payment burden is past the breaking point. 95,550 CA, median home about $1 million. $900,000 on about $101,000 household income. Price, to income ratio, 18.8. When the math stops working, Sellers find out before buyers do. These are not hand-picked metros. They are the loudest signals in the housing data right now, chosen by the numbers, not the narrative. Today's debate asked, are commodities in a supercycle, or is this the top? Let me show you what happened the last time we were here. Oil at $96.6 is in the 96th percentile. That means it is higher than 96 out of 100 days in the past year. In 2022, oil spiked above 120, then demand destruction pulled it back 40% in months. In 2020, oil went negative for the first time in history as demand collapsed. In 2018, oil dropped 40% in Q4 as growth fears overtook supply concerns. Different environments, different catalysts, but every time, the resolution came fast. The pattern is not the level, it is the speed of the move once it starts. Meanwhile, copper at $5.89 is in the 91st percentile. The last time both oil and copper were at these levels simultaneously, the resolution came within weeks. That is why the scoreboard matters. It tells you which speakers saw it coming and which ones missed it. History does not pick a winner here, but it does say the resolution is coming soon. Be positioned before it arrives. Here is what the data says to do right now. Stay alert on VIX. It is dropping 7.4% today. Fast moves demand attention. Avoid Phoenix at 42% payment burden. That is stretched territory. Phase 1 holds. No alarms, but the runway at 67 basis points is shorter than last month. 4 out of 7 speakers are right. The commodity analyst, Gammon, Snyder, and the volatility expert. When this many align, the trend usually has legs. Every signal is live at analyze.builderslens.com. 7 speakers, 65 signals, 1 question every morning. Who is right? Subscribe, and I will see you tomorrow morning.